Hello, everybody, and welcome to today's webinar. I'm glad that you could join us. And today we're talking about the final furlough. Furlough is a word that many people I know describe as the F word, but for an even greater number of people has been an absolute lifeline to survive the craziness of the last year and a quarter. So now that furlough is coming to an end, we wanted to just go through some bits that we felt business owners needed to know about how to survive the final stages of furlough and some of the wider implications for succeeding in the recovery phase. So today I'm being joined by Jarmans Solicitors. I've got Emma Lee joining me. But first I'll tell you a bit about who A4G are, just in case you don't know who we are. Just for the record, this picture was taken before COVID. In fact, this picture was taken, I think, about 2 months before lockdown. So we are a firm of accountants in Kent, but we do work nationally. We can travel all over. And these days, with everyone used to Zoom, that distance really isn't an issue at all. And we're dedicated to owner-managed businesses. Our mission statement is to be the best, not necessarily the biggest, advisor to owner-managed businesses. And to deliver that, it's all based on us providing advice, support and planning and going beyond just the simple compliance work that you may traditionally think an accountant does. As part of that, we have a two-person approach. Every client of ours has got two people who help look after them, a principal advisor like myself and a client manager who does the core of the managing the ins and outs of the work, and the principal advisor looks after the advice and everything comes through them. The reason we do that is to make sure that our clients have got access to someone to talk to, and with two people looking after you, the likelihood is at least one of us will be available. If not, then we have a highly systemized practice and all of our team will know how we work so they can find information that you might need. So that's enough about us. So today, as I say, I'm joined by Emma Lee, and she's going to be talking to us about a number of very important issues from a legal perspective, including the end of furlough, what that might mean for redundancies and processes involved with that, and liquidations and creditors' voluntary arrangements, whether that's something that may affect you directly or whether it's something that affects your customers and clients that you need to be aware of how those things work. And I'll be talking to you about the break-even point. I'll give you a little bit more about that later, and also discussing the implications for working capital, which sounds boring, but I hope that I can give it some explanation so it becomes more than just boring words that an accountant says quite often. So now I'm going to pass over to Emma. Here is Emma with us now. And she is going to start telling us about how the final furlough will affect us.
Thank you very much for the introduction, Josh. My apologies whilst I get my tech sorted out. I hope everybody can see the slides correctly. Good afternoon, everyone. Glad you can join us. As Josh has explained, today's talk is primarily around furlough and the effects of that, not just on us individually as business owners, but also the wider economy, and talking about what might happen as we come out of the furlough scheme, what businesses might need to consider in terms of their employment policies and so on and so forth. Essentially, I thought it might be useful for us to recap over what furlough in fact is. I'm sure we've all heard of it. I'm sure we've been involved in it or used it in some way, but to the extent that those of us who haven't, it might just be useful to explain it in a bit more detail. So essentially, furlough was invented entirely for the purposes of UK COVID lockdown 1.0. It was the practical effect of the coronavirus job retention scheme. Its intention was to reimburse the employment costs arising from the health, social and economic emergency that resulted from COVID-19. It's intended to be utilised by businesses who need to put staff on a temporary leave. That must be of no less than 3 weeks, and strictly speaking should be by reason of COVID, but it's not necessary to provide a business case, and as long as it's not used abusively or otherwise contrary to the purpose of the scheme, i.e. Making better use of resources in the difficult times that we have faced so far. During a period of furlough, the employee is not allowed to work for the furloughing employer. That doesn't stop them from working for other employers during that time, subject to any contractual limitations. And it doesn't stop you from asking your staff to do certain training, undertake certain training requirements whilst furloughed. In terms of the practicalities of it, the government guaranteed 80% of each furloughed employee wages up to a maximum of £2,500 per month. Employers had the option to top up the remaining 20%, but I'm not certain that very many really did. Figures suggested that less than 50% of employers that furloughed staff did pay that top up. I suspect it's quite a lot less than 50% in reality. It's not a right. So employees can ask to be furloughed, but they can't demand it. And ultimately, an employer's decision not to furlough a member of staff cannot be appealed. That said, a unilateral change to an employment contract to force furlough on an employee who is not happy to do it can be a bit of an issue and can lead to an unfair dismissal claim if the change is perceived to be material. So it was certainly up until fairly recently something that needed to be watched out for. Obviously, as we've gotten used to the furlough scheme, I suspect a number of businesses have already found their way through that difficult patch. Doubtless contracts identified the potential for furlough circumstances now, where they've been newly drafted or amended, but anything pre-April 20, I suspect, didn't really cater for that sort of change. And there has been quite a lot of challenge in the Employment Tribunal around the use of furlough. So, eligibility criteria wise, ultimately, a member of staff who needs to make a claim for on or before the 30th of April 21 has to be on payroll from the 30th of October 20 and must have submitted, you must have, as an employer, must have submitted a PAYE real-time information submission to HMRC between March 20 and the 30th of October 20 in respect of that individual, notifying HMRC of remuneration. You don't necessarily have to have previously furloughed that particular employee as long as the claim is made for the period 30th of April 21, they must have been on payroll on the 30th of October 20. If a claim period is from the 1st of May 21, then employees had to be on payroll since the 2nd of March 21 and the RTI submission made between March 20 and March 21. Those are important aspects because it does mean that certain employees may well fall between two stools in relation to the furlough, because if they've been employed since the 2nd of March and their RTI submission hasn't been made in respect of them, then strictly speaking, they don't get the contribution. The contract type is immaterial, so it applies to 0 hours contracts, it applies to fixed term workers, it applies to temporary workers as well. What it is based upon, the 80%, well, not 80% any longer, but certainly 80% up until recently, excludes discretionary payments. So bonus payments, commission payments, benefits in kind, all of that is excluded from the value that the employee receives. So ultimately, as I've already touched on, not everybody gets the help that they need. The self-employed don't get the benefit of furlough payments from the government, but they may qualify for assistance under the Self-Employed Income Support Scheme. As I've already said, those who missed the payroll requirement, i.e. they weren't in work on the 2nd of March 21, but has been furloughed on or after the 1st of May, if they have a very low basic salary that's topped up with non-compulsory commissions, car salesmen, those sort of scenarios, obviously they're not getting a significant amount of their 80%. Those perhaps with payday loan obligations and things like that, where there hasn't been a significant relax on the extent of their payback that they have to make. And importantly, from today's meeting, directors who take most of their remuneration through dividends, and I suspect Josh will talk about that in some detail later. Generally speaking, directors will for tax purposes, pay themselves dividends rather than income, and naturally that will affect the furlough arrangements that they will benefit from. It is possible to rehire anyone that's been made redundant since the 23rd of September 20 and put them on furlough again, as long as there was an RTI submission between 20th of March 20 and the 23rd of September 20. For claim periods after the 1st of December, you can't claim for any days whilst a furloughed employee is serving notice. So an important aspect there. So it doesn't matter whether that notice period is contractual or statutory, you can't claim for furloughed employees' notice periods any longer. And it's also worth considering in terms of the rehire, where you've made somebody redundant and made a redundancy payment to them. If you're rehiring them fairly soon after the original redundancy, then it could lead HMRC to determine that the redundancy payment received is a taxable payment and could have an implication for the employee at that juncture. In terms of the way furloughs developed, an important aspect really has been around national insurance contributions and pension payments. So between March and July 2020, the government was making its 80% contribution, and it paid the national insurance and pension contributions for employees as well. We then had the development of flexible furlough, where staff would come back into the office on a part-time basis. The employer would pay for the work that they did in the office, and then the 80% furlough would account for the remainder of their week, which worked quite nicely, providing that lasted for at least 7 consecutive days. Come August 2020, there was a change so that employers had to pay national insurance and pension contributions for affected workers, even where the business was closed, which obviously had a significant impact on cash flow in particular. And in that instance, short-term working and layoff clauses in contracts might have been a useful tool in one's arsenal, and that's something that we'll talk about in more depth shortly. And of course, redundancies and dismissals probably came to the fore at that juncture, or at least considered more carefully at that stage. Probably more financially attractive than taking advantage of the furlough scheme, but of course that does have an effect on the employee-employer relationship. So come September 2020, there was a 10% taper. So essentially, the employer was forced to pay not only the national insurance contribution and the pension contribution, but they were paying 10% of the 80% furlough payment. So the government was reducing their liability down to 70%. And similarly, in October 20, that changed again to 20% for the employer, remaining 60% for the government, with the employer still taking the pension and national insurance burden. Q lockdown 2.0, when we went back to 80% government contribution, but the employers importantly still managed the national insurance and pension contributions. The scheme was then supposed to end on the 31st of April 21, but it has been extended now until the 30th of September. So at this point, history has reworked itself. So from the 1st of July, employers are paying the 10% contribution, government paying 70%. So the figures look something like an employer paying £312.50 or up to £312.50 for each affected employer, the government paying £2,187.50 or up to that sum. And from the 1st of August, we're going back to the 20% scenario. So employers are expected to contribute up to £625 per affected employee of unworked earnings, and the government at £1,875. And all of that obviously has a significant impact on one's bottom line and your ability perhaps to pay tax. So there is still some financial assistance out there, even when the furlough system ends at the end of September. At the moment, HMRC has a dedicated helpline, primarily for self-employed, but also for businesses that are concerned about making their tax payments. The number's on the screen. It's 0800 015 9559. It's open Monday to Friday, 8 till 8 and 8 till 4 on a Saturday. There's also the option to, well, having taken the option, I should say, to defer VAT payments. One was, most businesses I think were expecting to receive a lump sum bill at the end of March 2021, but they've now allowed us to spread those payments over 11 instalments without an interest penalty, so a little bit of help, I guess. And following the budget on the 3rd of March, there was an announcement of a restart grant of between £6,000 to £18,000, depending on the industry that the business is in, that might be able to assist. So what next? Ultimately, it's essential that businesses and organisations plan for the return of the workforce now. Employers have furloughed most, if not all, of their staff in some circumstances, and they've got to consider a phased return to work in order to perhaps bring back key staff, department head managers, to plan for the return of the remainder of their staff where they've effectively furloughed all, and to start the process of booking and re-engaging with their clients and customer base. Obviously, the flexible furlough scheme remains in place, so it's still possible to utilise that arrangement until at least the end of September. Thereafter, flexible and agile working practices and contractual terms might need to be considered further, with a reduced need for office attendance, core hour changes, an emphasis perhaps on productivity over traditional working days. And certainly one of the areas that is likely to be looked at in more detail is changes to contract terms. Some industries were historically considered by employment lawyers as fairly high risk, that they can suddenly run out of work, perhaps unexpectedly in some instances, construction, trades, manufacturing in particular. And very often when the lawyers are producing contract terms for their employees, they are looking at short-term working and layoff as options to be incorporated into those sorts of contracts, to give the employer a bit of flexibility about not needing to have staff working at any particular time and keeping costs down as a result. Absent such a clause, there is often no implied right to be given work, but there is an express right to be paid nonetheless. So the beauty of a short-term working or layoff provision working in force is that an employer can not have the employee at work on any given day and will still have to make a payment, but a vastly reduced one. Ultimately, a guarantee payment at the moment amounts up to about £30 per day. Eligibility is quite a complex area, so not something I want to get too excited about today, but a bit of bedtime reading. Section 28 to 32 of the Employment Rights Act 96 deals with all of that. There's a whole bunch of case law on it, as you might imagine. So do take some professional advice around it. The important part, though, to take away for today is to unilaterally impose new terms is a really bad idea. So that can lead to all sorts of claims in the employment tribunal, and best avoided so that you don't have any issues for the future. So that will do me for the moment. I'm going to come and talk to you more about redundancies, which I think are going to be really quite topical over the course of the next 3 to 6 months. A little later on.
Lovely. Thank you very much, Emma. So that's a bit about the end of the furlough scheme. So now I want to talk about the next step, how we go into recovery and how we make sure that going into recovery, our businesses work for the business owner just as much as it does the employees. So this is where a break-even analysis might come in. Now, historically, a break-even analysis is based on a calculation for how much turnover your business requires in order to make no profit. But at the end of the day, no profit is not very useful to you as a business owner. We're not in business to make no profit. We're in business to make at least some profit. And the minimum amount of that profit is usually defined as the amount of money that you need to draw from the business. As ultimately, if you're a company, then you're, as Emma alluded to, most of your income will be in the form of dividends. Dividends can only be paid out of profits, and those profits have to be after-tax profits. And this is often where a lot of small businesses come unstuck, where they haven't kept enough money in the business to pay for the corporation tax, and as a result, there's not enough after-tax profit to cover the dividends, and it can lead down a road of problems. So how do we avoid those sort of problems, and how do we make sure that you as a business owner are earning the right amount? I've spoken to many business owners in the past who say, do you know what, I've got employees who earn more than I do, and it's always an incredibly demoralizing position to be in. Well, doing a break-even analysis is the first step to protect yourself as a business owner from those problems. So rather than looking at the profit and loss from the top down, so looking at the turnover and working our way all the way down to profit, we turn it on its head. We start with the bottom, and the bottom of it is actually beyond profit. It's what do you need to earn from this business? So you might start that from looking at your monthly personal or lifestyle costs and use that as the minimum amount your business needs to provide you with income. Or it might be that you've got an idea of saying, actually, no, in the future, this is how much I need in order to be, effectively rewarded for what I'm doing. I can't live on the small amount I've been living on over the last year. I need to increase that, and you can set that number. That's the starting point. If you know the number you need, the rest of this can flow from that. And then the next step is to work out, well, how much of that income comes from your business? You may have other investments that provide part of that income. And then once we know that number, we can then calculate how much tax you'd have to pay on this. Now, for this example today, so it doesn't get too confusing, I'm going to assume that we've dealt with the personal tax side of things, and we're saying, actually, this business needs to provide £30,000 of dividends, and that will cover the tax you have to pay on those dividends and give you enough to live on the rest of it. Chosen 30 because it allows the numbers to stay relatively sensible for this discussion, but obviously there might be complexity in, every business is unique and every person's financial position is unique, but we've got tools that allow us to work these out fairly easily. So let's start with 30,000. So if you need 30,000 of dividends, then you're going to need 30,000 of profit after tax. Okay, so now we've got 30,000, we can gross up and say, well, actually, to earn 30,000 after tax, we know that corporation tax is 19%. So therefore, you'd have to earn £37,037, which would be taxed at £7,037, leaving you with 30,000 to draw out, knowing that that's your money and no one can take it back off you. So at this point, we've got the bottom line of your business, ignoring tax. Obviously, if you're a sole trader or a partnership, that tax figure will be slightly different. The downside to being a sole trader or a partnership is that personal tax applies rather than corporation tax, which is variable depending on your profit level. It can still be done. This is where using the brains of your accountant becomes quite important, because we can do those calculations and that gives you that bottom line. Right, this is the profit we're targeting for the year. Okay, so how do we make that profit? Rather than now jumping to the top, let's go methodically up the list. So let's look first at overheads. Now, historically, when we've done these calculations, we've looked at the prior 3-5 years of the business, saying, well, what are the overheads been for those previous years? And either work out an average or work out to say, well, actually, no, you've had to increase capacity at some point, so you've increased your costs. Well, at the moment, using that historic data is going to be slightly flawed, because your overheads are probably subdued because you could have had furlough claims, you've had the potentially you could have had the grants from the councils. They may be subduing what your overheads are. On the other side of things, you may have entered into COVID like many businesses did and gone through a big swathe of cuts to reduce your overheads, cutting down how much you're spending on your overheads. So the overheads calculation is probably one of the more complicated parts of this calculation. You need to be looking at, right, what do we expect to go out each month? And of those things, there's probably some additional items that only hit you every 3 months, 6 months to a year, making sure that you've put all that in there. Once you've got that figure for what the overheads of your business are, you can then populate that in there. So let's say in this case, in this example business, they've got office costs of rent and rates. They've got office staff who are non-productive, so they're just, say, the receptionist. And they've got essential suppliers, so print and stationery, things like that. And you've got the costs of finance might be in there, it costs of insurance, things like that. Let's say all of that comes to £30,000. So that then allows us to say, right, this business's operational side, the actual, right, this is what we're going to sell to our customers. We know what profit we need to make in a year to cover both the profit before tax and the overheads. So we basically add the profit before tax to the overheads, and that gives us 67,000 is what this business needs to make in gross profit. Now, gross profit is the calculation of your turnover less the costs that you incur in order to deliver those sales. If you're a service business, most of your sales will be generated from the work that your staff do. So your cost of sales would be that staff cost. If you're selling products, then that cost of sale would actually be the products that you're buying. Most businesses, there's probably a bit of both. More commonly, you'll find most businesses most small businesses have a larger proportion of wages cost in that cost of sale. But if you're an internet business, then maybe it's all cost of sale is the goods that you're purchasing. So now for us to finish this calculation, we need to understand what the gross profit margin is of your business. So that is your gross profit as a percentage of your turnover. Now for this, we would tend to use the historic figures, but you may find that actually in the current climate, your sales mix is different to how it's been in the past. So you could use your historic data. You know, accountants love telling you what your gross profit percentage is, but you need to assess whether that percentage is going to be accurate going forward. So if you've got a different product line, understanding, okay, this is the product, the margin I'm going to make on those products, and we can then calculate from, okay, I'm going to sell this much of product A, this much of product B. We can then work out what your going forward gross profit percentage is. So in this case, we've chosen 35%, which seems like a reasonable gross profit margin. We can then use that percentage to then gross up the gross profit. So in order to make £67,000 gross profit at 35% gross profit margin, you'd have to turn over 191,500 and you'd have cost of sales of 124,500. So now this looks like a traditional profit and loss, but we've started from what you need to draw. The overheads should be realistic and the gross profit margin is realistic. The cost of sale and the turnover are therefore effectively balancing figures. And this gives us a turnover target. You could say, right, next year, I need to turn over just under £200,000 for me as the business owner to earn what I need to live on from this business. Can we achieve that? Now, the problem is an annual target is a bit ethereal. It's hard to grab hold of that in the day-to-day grind of the business. So you can break that turnover target down. You could actually say, okay, we need to turn over this per month. And for many of our clients, we would flex that based on their seasonality of their business. But you can then actually go a step further. You can work out how many productive days your business has in a year and then work out an average daily turnover. So if you're invoicing every day, that's a really good metric to use because no longer are you waiting to build up this very down the pipeline figure of your turnover. You're now looking at today, I need to have sold £734 worth of stuff. And you can very quickly work out if you are or are not meeting that turnover figure. And of course, you can then compare that to your results and you can say, yeah, okay, I've sold more than my daily turnover figure today. You're in the green. You're expecting to get higher profits than you're forecasting from your break even. That's really good news. Your business has either got money in it that you can then invest further in growth, or you could take additional dividends. Or what often happens is this ends up being the thing that we consider when we're looking at, okay, we've got staff, we need to do a staff pay increase. What sort of additional margin do we have in the business? Let's look at the bottom line. How have we beat our targets? And then apportion that between the different uses we need for that. Excess profit not being a term I'm a great fan of. Of course, if your average turnover is less than this daily turnover, then you've got a warning sign, and you've got that warning sign early. You can say, okay, we didn't sell enough today. You can push your operations team, push your sales team. Do you know what? We're not earning enough. We need to do this. And you've got a very practical and immediate goal to hit. So it can be a really, really useful tool. Now, obviously, every business is unique. And of course, as a result of that, you would need to consider different things in this calculation, but that's where we can help. We've got tools that help businesses work all of this out. And if as over time your overheads will change, your gross profit percentage may change, we can flex these calculations. But the whole idea behind it is to try and remove that fog of war, the not knowing what the year end is going to be like. We can give you as much foresight as possible to know what that end position is going to be. So that's just one of the useful tools in our arsenal for working through this recovery phase to make sure that the business is working for you and not just making you, well, as they say, a busy fool, where you're working really hard but not earning out of that business. So now I've gone through a lot of numbers, and I'll give you a break from the numbers from me as a classic accountant. I will hand back to Emma, who's going to talk to us about some of the scary stuff to do with redundancies and insolvencies. I don't think we can see it. There we go. We've got Emma.
I'm here. I was doing my tech first for a change. Thought I'd try that. So yeah, leading on from what Josh is saying in terms of making the business work for you, one of the major areas that he touched on is the staffing costs, and certainly as we are looking at the effects of COVID, the effect on your bottom line, staffing cost is quite a significant aspect of that. And consequent upon COVID, generally, redundancies are inevitable, I think. It's widely forecast that between 1 in 10 and 1 in 20 people will be made redundant during the course of 2021. The hope is that because of the extension of the furlough scheme, the numbers are coming down a bit, but I still think it's going to be quite a significant element of our employment future for a while yet. I mean, furlough supported many businesses for an awful long time and continues to do so as the country reopens, hopefully on the 19th. Obviously, what happens after this with the potential for further spikes in infection rates resulting from the variant strains that are kicking around remains to be seen. So it's difficult to predict with any sort of certainty what might happen. But what we do know is that the furlough bill alone has come in at over 100 billion quid with corollary reductions in tax revenues and so on and so forth. So it simply cannot carry on like this. I'm not certain that even if we had a further lockdown, that furlough could carry on in quite the same way. Otherwise, I'm not certain the economy could cope with it. But to look at it on a more parochial level and dealing with it within your own business, ultimately, one of the major questions that I'm asked quite a lot is whether redundancies are possible within the context of furlough, bearing in mind the idea of furlough was to avoid redundancies in the first place. The short answer is yes, it is possible to make redundancies within the furlough period, as well as dismissing for any other reason. So if you find that there's been breaches of contract or so on and so forth, there's been some derogatory comments made within social media or something like that, then all of those things make it possible for a potential dismissal within the furlough period, irrespective of the fact that the employee isn't strictly working. Planning for the end of furlough and the reopening of the country post-lockdown should include a really robust HR strategy, which actively reviews the workforce and the business needs. It is worth considering having a redundancy policy in your handbook if you have one. If you don't have one, it is my absolute advice to get one. It doesn't really matter how small or big your business is. A handbook is an incredibly useful benchmarking tool. It sets out what your expectations and requirements are of your staff, and although it's typically not contractual in nature, it certainly has some fairly persuasive force if there are breaches. Arguably, this strategy should have already been done, but it's never too late to make painful decisions where it's necessary around redundancies and implementing those determinations to avoid ultimately the unnecessary waste of resources, because obviously you've got all of your employer contributions, your national insurance, your pension that you're having to pay out during the furlough period, as well as the contribution to furlough payments themselves. If you know that the role no longer exists or the need for a particular type of work has diminished quite dramatically, either by reason of COVID or by reason of new developments and changes within the workforce that's happened over the course of the last year or so, then those things ought to be considered carefully now and keep your costs down as much as possible. The process of redundancy, when spoken about, it seems relatively straightforward, but it's very easy to fall foul of the process, and that can cause significant problems in the employment tribunal if there's a step out if you miss something that's important, if there's a discriminatory element. So it is worthwhile taking professional advice at all stages. But in a nutshell, redundancy is achieved ideally, firstly, by inviting voluntary redundancies. Very often, the people that come back to you are probably longer term staff that are going to get a decent payout, and you may or may not agree that redundancy, it's not obligatory to accept a voluntary redundancy request. You might find that it weeds out a few disgruntled members of staff as well, who are taking the opportunity to get out with a payment, and that sometimes is beneficial to avoid that extended toxic scenario. Once you've gone through the voluntary redundancy process, if you decide to go through that process, then the next step is to identify a pool of those affected employees. It's not often that there is one single person in a pool. Sometimes it is, depending upon the roles and responsibilities, but very often, depending upon the size of the organisation, you are looking at a pool of managers or a pool of admin staff or something of that nature, and you need to look at everybody together. Where I suppose the test of whether the people ought to be in a pool together or not is really looked at by reference to their job descriptions and their actual roles. And if one can do the other's position, then generally speaking, they ought to be in the pool together. It's important then to operate a fair and transparent selection process, which ought to include individual consultations with all of those that are affected, proper correspondence going out to them to explain that they are at risk of redundancy, the reasons for that, the intended scoring matrix, and it's well worth having a proper matrix that sets out the selection criteria and the scoring system, whether that's 0 to 10, 0 to 5, which aspect of that scale is considered good, which aspect is considered bad, and so on, so that there is a clear and defined scoring regime. And those scoring matrices ought to avoid discrimination, be careful about part-time workers, and be cautious of referring to any issues of lateness, sickness, and so on and so forth, where you have potentially disabled workers that would come under the Equality Act. So just be cautious of those things. Once you have used that scoring mechanism, another meeting individually to explain those decisions around the scoring given. Listen to members of staff about options for avoiding redundancies, the potential of a suitable alternative position might be worthwhile considering as well. Well, it's definitely worthwhile considering, and it's worthwhile knowing that suitable alternatives need to be objectively suitable, not subjectively. So if Joe Bloggs on the street thinks that it was an appropriate offer of a job in a different department or something of that nature, then generally speaking, that's considered okay. There is a statutory trial period of a month for the employee to give it a go. And if it doesn't work out for one or other of you, then it's possible to revert to the redundancy scenario at that stage. Subject there too, you have to give proper notice of the fact of dismissal, the reasons for it again, and give paid time off as appropriate to members of staff to look for alternative roles elsewhere. As I've mentioned, it is possible to make a bit of a hash of a redundancy scenario. Either the selection process wasn't perfect, or a consultation process didn't go well, or an appeal doesn't satisfy an employee. In those sorts of circumstances, or in order to just avoid the whole thing, it can be worthwhile considering favourable severance terms, which can be incorporated into documents called settlement agreements, which I will explain in a bit more detail shortly. Redundancies, generally speaking, if they're fairly small scale, are very much an internal affair, don't need to be discussed any more broadly than amongst you and the affected employees. Very often, in fact, there is a request to keep things fairly confidential, because we don't want to unsteady an otherwise steady ship, were it not for a couple of roles that could do with saving on the costs. But where we've got quite large scale redundancies going on, then there are slightly different rules that apply. If you've got 20 or more people being proposed to be redundant within the next 90 days at any one establishment, then ultimately we have to set up collective consultation, which involves the representation of each of all of those individuals by one or more people, and the consultation happens with them and then individually, and that's for anything up to, well, any number of employees being made redundant, as long as it's over 20. 20 to 99 employees, they have to be notified at least 30 days. Well, the collective consultation process has to be started at least 90 days before the first dismissal is intended to take effect. And if you're talking 100 or more staff to be made redundant, then it must happen at least 45 days before the first dismissal is intended to take effect. So there's a lot of planning goes into making that sort of number of people redundant at, within a 90-day period. In addition to that, there's an obligation on the employer to notify the Department of Business, Energy and Industrial Strategy of the fact of the redundancy where there's quite a significant number. So, why is my slide moving? What's happening? Oh, finally it's woken up. So the next big question is, how much does redundancy cost? In some circumstances it's relatively inexpensive, depending upon really how long a member of staff has been with you for. Redundancy is calculated on a formula based around age, length of service and salary. So there's a multiplier of 1.5 for members of staff of 41 and over, a multiplier of 1 for those between 22 and 40, and a multiplier of 0.5 for 21 and under. The length of service is obviously the complete years served with you as their employer, up to a maximum of 20 years, and their salary is based around a weekly statutory cap of £544 as of the 6th of April 21. So taking all of that into account, the very maximum payout you can ever expect to pay is £16,320, and that's for your longest standing, oldest employee who's on the most money. Plus, obviously, you've got to pay their notice, whether that be contractual or statutory. Contractual where it's better than statutory, statutory where it's better than contractual, and accrued but untaken holiday, all of that with the exception of redundancy being subject to tax and national insurance deductions. The gov.uk website has a handy calculator, so if you're ever in doubt, pop along to the website address that's on the slide, and that will prompt you for the various bits of information, and will give you the figure at the end of it. But as I've suggested, getting it wrong can be really quite expensive. A bungled or sham redundancy will cost at least the redundancy payment, because that's the basic award in the employment tribunal, as well as your other contractual payments that you're obliged to pay anyway, plus further sums in respect of lost salary, often around 3 or 6 months worth of pay, and potentially additional damages for discrimination. So I can't stress enough the importance of getting a redundancy scenario correct, or way of avoiding the process altogether. In other words, you don't have to go through a full redundancy selection process and so on and so forth, or the risk of getting it wrong is to conclude a settlement agreement, which I touched on briefly before. The idea of that document is that it essentially buys off the risk of a claim. So the employee gets an enhanced figure for agreeing terms with you, but those terms primarily identify that the employment comes to an end, that there are obligations around confidentiality, not making derogatory or disparaging comments about one another, and also avoiding the risk of a claim. The employee is expressly required not to issue proceedings in relation to employment-related matters. So it's a very useful tool. It does add a small layer of extra cost because obviously you've got to get it drafted, and typically there is an obligation on the employer to make a contribution to the employee's legal fees. Very often something around the region of 350 quid plus VAT, sometimes a bit more depending upon how complex everything is. But it is, as I say, ultimately a much cheaper option than potentially ending up in litigation, unless you've got the benefit of legal expenses insurance. as I say, ultimately, the takeaway, I think, for the purposes of redundancy is to take independent legal advice and make sure that you're dotting your I's and crossing your T's, and or considering the alternative to avoid the potential wider problems. Ultimately, leading on really from what Josh was saying in terms of insolvency, or say break even, is where a business is simply not working as well as it could be. It's got to a point where it can no longer afford to pay its debts as they fall due, which is the definition of insolvency, courtesy of Section 1231 of the Insolvency Act 1986. And I think in many ways, whilst redundancies and so on and so forth will be useful to businesses to help steady the ship, there will be some that simply cannot carry on post the furlough arrangements coming to an end because their employee base is too extensive, or their costs are too high, and the recovery process is going to take too long. The question is really whether businesses have been artificially supported by the government for quite a long time, and consequently, I think there has been a number of businesses that have sort of zombied their way through the furlough arrangements and so on and so forth, and the COVID lockdowns. And when we emerge, simply won't be able to trade going forward. Ultimately, from an employment point of view, in the event that employees aren't paid, then they are creditors like any other. If they are owed more than 750 quid by a limited company, then they're entitled to bring a claim to the insolvency court and ask the company's insolvency courts to wind up the business for failing to make payments. Ultimately, insolvency is well, an insolvency process, I should say, might be a useful tool. Administrations, CVAs, which we've indicated that we're going to talk about in more detail, and those sorts of things can work really well. CVAs in particular operate so that a company can indicate to their unsecured creditors, importantly secured creditors can't vote on this stuff, that they intend on potentially liquidating their business because it's becoming insolvent, or it has become insolvent, and identifies ways in which it intends to continue to trade, but in many ways is resolved by reducing its debts. So it can say to its unsecured creditors, look, I know I owe you this much, but I am going to pay you less than that over this period of time, in order that we can all do better out of this scenario than if we go into liquidation now. And that is really the purpose of a CVA. It enables the business to carry on trading with its current directorship and manager scenario. Sometimes those get changed depending upon the circumstances. It enables creditors to recover at least something where they might get nothing on a liquidation, or they might get something far less on a liquidation. It's possible that a CVA can be breached. It is not always the case that they are followed, absolutely, and naturally it depends on a number of factors for it to be successful, but it can certainly be a very useful tool. If for whatever reason a CVA isn't appropriate, then an administration might work too. It's very much considered a rescue tool for a business that could trade out of the scenario prior to going into liquidation. And again, whether it's got the possibility of succeeding or not will be determined primarily by the insolvency practitioner, but it's very much my advice to go and speak to one fairly quick smartly if we think that our business is not doing as well as it should or as well as it could, and it's something that we don't think we can trade out of. Ultimately, the directors do need to be particularly cautious as to their liabilities. that arise in their dealings with a business which is insolvent. The reason why it's important to go off and speak to an insolvency practitioner fairly soon, or insolvency lawyer, in fact, soon, if you think that your business is going to fail, is to avoid the potential pitfalls as a director. Just because you have a corporate vehicle does not leave you in a situation where you are free of personal liability. Quite the opposite. So as a director of a business, you might have personal responsibility flowing from transactions around preferences, where you have preferred one creditor over another, where there has been transactions at undervalues, where you've given away some asset or other, or you've given it cheaply, and ultimately where there's been wrongful trading. All of those things can lead to personal responsibility. So you do have to be incredibly careful about the effects of all of that. But that's a very broad topic, and one that, again, I think you need to take independent legal advice on to make certain you're dotting your I's and crossing your T's. And on that happy note, I shall pass back to Josh.
Thank you very much, Emma. So I think one of the most important things to think about here is how to avoid having to go down the routes of insolvency or CVA. So to understand how to avoid the perils of an insolvent business, we need to understand this concept of working capital. Now, working capital, I would translate as being capital, basically meaning cash, and working meaning the operation of your business. How much cash does your business require to carry out its operations? There's the old saying of turnover is vanity, profit is sanity, and cash is king. So when we looked at a break-even analysis, working out how much sales, how much turnover you need to make in order to make the profit that you need in order to earn your lifestyle costs, we were just looking at turnover and profit. We hadn't dealt with cash. And now to consider cash, we need to look at working capital. If your business hasn't got enough cash inside it, then there are potentially two causes. The cause could be that there's a profit problem, or the cause could be that there's a working capital problem. A profit problem has a number of things where you can pinpoint the things that you can do to deal with it. You could be saying, well, are we selling enough? Are we selling frequently enough? Do we have the right products in our mix of sales? Do we have enough capacity to sell enough in order to make the profits that we've got? If you've got a volume business, you need to sell a large number of items in order to cover your overheads. If you've got a high margin product, then you need the ability to deliver that high margin and maintain that. And also you have questions about pricing. At the moment, we're seeing a lot of inflationary pressure and a lot of problems with supply, where many businesses I'm speaking to are having struggles trying to get hold of things that they usually use in their business, either to sell directly or as part of that process. And that is causing prices to go up. And it takes a lot of guts for that business to then go, do you know what, our costs have gone up, I need to pass that on to you as my customers. And you see a bit of this push and pull on pricing. The other aspect to look at, which is the bit, as I say, that people look at when we went into the COVID crisis, is, are your costs of sales, your materials and wages, are they competitive? Is there anything you need to do to cut costs there? Is there anything that you need to do with cutting costs in overheads? But really, the equation for the profit problem, yes, you need to be in control of your costs and overheads, but there's the phrase of offense is the best defense. And if you're looking at the sales sides of things, it will usually have higher compounding to cover your profits. Looking at the sales side is often more effective than cutting costs, because if you cut costs, does that actually hinder your ability to deliver the sales that you need? Now, on the other side, if it's a working capital problem, you would be looking at a situation where the business is profitable. So we've done the break-even calculation, we're hitting our break-even turnover, the gross profit margin is as we expect, overheads haven't gone up, we are making a profit. So why don't I have cash in my bank account? Well, let's have a look at some examples for how this might happen. And it's interesting because when we talk about insolvency, we talk about insolvency being the ability to pay debts as they fall due. And that definition in itself doesn't mean the business has to be not profitable. And it doesn't mean, sometimes we look at balance sheets and there are less assets than there are liabilities. So the business owes people more than it has in assets, but actually it could still be solvent because it can pay people as they fall due. And that's all about cash flow. So let's have a look at how this might happen. So I've got very simple numbers here. So we'll say in month 1, you sign up a contract. You've got no profit, no cash from just signing up a contract. In month 2, you start the job. Now let's just pretend, for simplicity's sake, you've got £1,000 of costs in that. Let's just say you've paid someone £1,000 to deliver the service you've promised on that contract. So now you've got negative £1,000 of profit because you've only got costs, you've not made any sales, and cash. As an employee, you've had to pay them at the end of the month. So you've got £1,000 into your overdraft. Month 3, you raise the invoice. Now you've sent that invoice to your customer, so you've made a profit because we've got a markup on that. But that customer hasn't paid you yet. Let's say that they haven't paid you by the end of month 3. That means your cash position is £1,000 down, even though your profit is saying, you know what, you've made £250 on this. And then in month 4, let's say you start a second job, but you still haven't yet been paid for the first job. You've now incurred another £1,000 of costs in order to fulfill the second job. So now your cash, you're £2,000 into your overdraft. And if we ignore accounting for stock and work in progress, then your profit would be showing negative 750 because you've paid your staff for 2 months. You've only got 1 month's worth of invoicing in. So actually, if you just took a snapshot of those figures, they look a little bit scary at that point. Now, let's say in month 5, you then get payment from that first job. So now your cash has been reimbursed for that first job, but you're still £750 into your overdraft because you've still paid the workers for your second job before you've had any money come in for that second job. Month 6, you raise an invoice for that second job. So now your profit is up to 500. So that's good. The profit is going up, but your cash position hasn't changed because raising that invoice doesn't mean someone's paid you. Then in month 7, you start a third job. So again, cash is down. You've paid staff to do that in that job, and you've had to pay them. So your profits are down as well. And then in month 8, we're then you get the payment for the second job. And now your cash comes up again, but you're still £500 into your overdraft. And then month 9, let's say that you raise an invoice for the third job. And you can see how your cash is lagging behind your profits. If we're looking at it in this way, I know it's a very simplistic way and a real business wouldn't quite work in this way where you'd probably have payment in month 3 at the same time you're starting your job. But just to keep these numbers clean so that you can see the trend, you can see that profits generally are going up and cash is slowly going up, but it lags behind the profits. Here is a chart, because you can't have life without a chart, can you? So the orange line, hopefully this is visible on everyone's screens, is your profits, and the grey line is the cash position. So your cash starts at 0, plummets down to this lowest point of 2000, and then it starts to go up. So using that same pattern of producing work, raising the sales invoice, getting paid, if all of that worked mechanically every single month, and you were invoicing the same amount every month, with the costs of that being the same every month, which obviously every business would love to have everything being that linear, but for the sake of this argument, this would take 28 months before that business isn't in its overdraft and doesn't require its overdraft consistently to provide that working capital requirement. So we could say, actually, this business at the beginning would need to borrow £2,000 from the bank in order to keep its working capital supplied. Whether that working capital is provided by the bank in the form of an agreed overdraft or a loan, but generally a loan would be cheaper than an overdraft. But of course, this is based on a business that's just doing the same thing, churn, churn, churn. There's no growth in this business. Now, with each unlocking of the economy from, as each time Boris says, right, everyone can go and do more things they want, opening bars, opening shops. I think of it, it's a bit like Gladiators, the TV show, where every business is one of the contestants in Gladiators, and they're saying, you will go on my first whistle, you will go on my second whistle, and off we go. Now, the thing with that is we're all coming out of the stocks with a huge amount of adrenaline and energy, and usually, hopefully, fingers crossed, a lot of demand for what we're providing. And that means that we'll go through a phase of increased growth. So now let's look at this model with growth built in. Now I'm looking at this model with only 5% growth built in. And if we do that, then it means that each month the sales price goes up by 5%, but also the cost of fulfilling that sale goes up by 5%. So this is 5% growth, not because you're charging more for each product, but because your customers are asking for more. And in this case, the break-even point for cash, the moment when you're no longer needing the bank to provide you finance for your working capital, is now 37 months before it actually goes above that zero line. So that means for 5% increase month on month of your sales volume, it actually takes a third longer for your bank account to catch up and get to zero. And this is the problem with growth. Some people would call this overtrading. If your business is growing faster than your supply of cash can cater for, then that's called overtrading, where basically you've got profitability, you've got the customers, but you don't have the cash in order to fulfill your obligations to your suppliers and your staff. And that's when that definition of insolvency comes in, because you might be a very profitable business, but if you can't pay debts as they fall due because you've got orders coming in quicker than you can fulfill, you could come under attack from your suppliers that you're having trouble to pay. So having a plan for working out that capital, your working capital, is vitally important. As ultimately your growth has to be funded. And going into all the lockdowns in March last year, it was interesting. A lot of clients that we were talking to actually were saying, do you know what, I've got more cash in the bank now than I've ever had before. And that's because as business declines, you're not having to pay out, and certainly with the furlough scheme covering staff, your cost base was going down. And actually the train of people paying you those invoices in arrears, so people have taken a month, 2 months, 90 days, whatever your terms are, that money was starting to trickle in, and your cost base was now very low because you weren't generating sales. So a business in decline can appear to generate more cash. And now we're in the opposite phase. We're now having to grow, so we're having to inject cash into the businesses an economic way of describing it is pump priming. You have to put money into a business in order for the business to generate more money out at the end. So yeah, this higher growth brings in significant risk to your business and the businesses that you interact with. That, how is that working capital working? So how can you improve working capital? You could look at supplier payment terms. You would want to make them as long as possible to buy you time, so that ideally you want to match it so that when your customer pays you, you pay your supplier at the same time, and therefore your customer and your supplier, you're not having to finance any of that because they're matching up the payment terms. You also might want to risk profile your key customers and suppliers. You don't want a customer to be having these working capital problems and then they say, oh, do you know what, I can't actually pay you for another month or two, and they drag that on. And likewise, if your suppliers are having insolvency problems, they may not be able to deliver what you need in order to trade. So you need to be aware of that, and you may want to do risk profiling using credit checking companies and analysing it. I've got a number of clients who will email me a link to companies' house, say, Josh, can you just check this company out for me? And I'll give them a very brief view of what I can make out from what's on the public record. And of course, there are finance options, whether that's going to the bank for a working capital loan, whether it's refinancing assets. A number of businesses use factoring, and actually factoring, although it tends to have a very bad rap, is actually a very useful financing function when you're growing, because the faster you grow, the more money the factoring company give you, as they basically, as you raise an invoice and they give you 80%, say, of that invoice value. You know that every time you raise an invoice, almost instantly, you've got cash inside your machine of your business to keep doing more sales. But factoring has a high cost. The other options that you have is that if you've got a bounce back loan that you've not used yet, and there is the availability of the new recovery loans, which are slightly harder to get than the bounce back loans, but could be quite lucrative. You could also look at your margin, because in those examples, we weren't increasing margin, we were increasing volume. But if you actually increased your margin, so your cost base for providing a service stayed the same, but you made more on each sale, then that would speed up the time in which you get out of that overdraft position, or get into a self-financing position with those projects. Other things that you may want to look at is efficient uses of losses. If your business has been loss-making during COVID, then there is a possibility that you could seal off a year end and carry that loss back to a previous year in which you had corporation tax to pay or income tax to pay if you're a sole trader or partnership. And we can then apply to get that refunded to you by carrying it back. And that can give you a cash injection pretty quickly. And they've increased the rules, so we can now go back 3 years for a brief period of time to try and inject that cash back into your business. And a number of businesses have spent a lot of time over COVID researching and developing new products, looking at expanding what they do. And as a result, quite a few of our clients have got research and development claims that they can make where HMRC will give them an extra 130% on whatever they've spent to put against their tax bill and actually get a bit of a tax rebate as a result. And there are some grants available, although grants, you've got a lot of published information saying, yes, we're going to release these grants. And whenever I look into them, like, yeah, we'll tell you when it's available, we'll tell you when it's available. But most of my clients need the money now. But we do have some specialists that we have contacts with who can help secure grants. The thing with grants is to, what project you're trying to do that needs the grant, go and look for a grant before you start the project. That's the top tip that I've been given. And then we've got things where we try and help translate the accounts to give you answers on this working capital. That could be a breakthrough service where we go deep diving into the underlying issues of working capital and profitability, or even on a more simple level when we do quarterly management accounts reviews, or our headline service is a pre-year-end meeting where before we reach the year end for our client, we will meet, go through the figures, and we can do those sort of analysis. What's the working capital requirements? What's the break-even analysis? If that's the sort of thing that your business needs to have reviewed. And the other thing that we do is review the quality of your data. If your bookkeeping data is not up to spec, then you may not be getting the right data in order to make the right decisions based on, are you making your required break-even daily invoice turnover? Are you correctly monitoring your overheads and gross profit? Or are you keeping track of those debtors and creditors in order to manage that working capital cycle of your business? So I'm sorry, that was quite a techie one. I hope that I've explained it in a way that makes sense to everyone. If you need any extra help with this sort of thing, then please do let us know. Now, hopefully people have been putting some questions and answers in the question and answer box. So I'm now going to, Emma, if you would like to turn your camera back on and join us back here, and we'll see if we've got any questions in the chat. So I'm going to stop sharing my screen, as we all know there we go. So I'm back there, and I'll now have a look. We've got some questions. Okay, so we've got a question here. I think this one will be for you, Emma. It says here, I may not have been entirely honest about the furlough arrangements with my staff. Do I really need to be worried about HMRC pursuing me for furlough fraud?
Oh, well, the short answer is yes. Ultimately, there was an amnesty. Initially, the government took the view that there would be a number of errors made, and it would be easy to sort out if everybody would own up where they've been paid too much and so on and so forth, and gave that opportunity. That's now closed. Essentially, the rule very much is that fraudulent claims needed to be notified and sorted out. There is now a task force being put in place with 1,000 investigators, I understand, being tasked specifically with identifying furlough fraud and bringing errant employers to book. So it is being taken very seriously. Employees certainly over the course of the last year or so have been actively encouraged by HMRC to report their errant employers as well, and obviously all of that falls under the public interest disclosure arrangement, so whistleblowing, in which case they can't be held they can be held responsible, but they cannot be treated unfairly as a result of any such whistleblow. So it is something to be cautious of, and my advice, generally speaking, when it comes to anything tax related, is put your hands up and be honest about it now.
I'd agree with that. They do tend to be more lenient, maybe not the right word, but they do tend to be more considered if you're saying, no, this is wrong. Give them something and then they'll go away quicker. Is
Absolutely.
my view with HMRC. Another question here on furlough. What issues are there if you want to take someone off furlough but reduce their work hours going forwards?
Good question. The issues primarily are around the changes to their employment contract. So wherever you as an employer are seeking to vary the terms of a contract, you have to be incredibly careful not to do that without proper consultation and without discussion and agreement. And it's that latter part that's really important. A contract with your employee is like any other. You can't just change a commercial contract without the other side expecting to have something to say about it. And the same applies with your employees. So if you want to do it, there's nothing to stop you from having the conversation with the member of staff concerned or members of staff concerned. And if there is a consequence, if there's a reason behind wanting to make those changes, then you need to be very clear about that. If the alternative ultimately is that that role is no longer necessary and that you think you can subsume that task with other people's full-time hours, then the potential consequence is redundancy, and they should be aware that that's a potential scenario for them going forward. So the short answer is be incredibly careful about unilateral changes, make sure you get agreement. If it's the employee that wants to make those changes, then it's a flexible working request and ought to be dealt with accordingly. But whereas you as the employer, then it's just about caution around unilateral changes and getting agreement, really. Thereafter, once off furlough, there's no particular practicality that's at issue. It's purely around your relationship.
Cool, thank you very much, Emma. I hope that's helpful. As I realise we've gone over time a little bit, so I'll just search through here. We've got a few questions. I'll just answer one more, and there's one here, I think, for me, and that says, will dividends still be tax efficient for drawings after 2023 when the corporation tax rate changes? Now, I've done some initial calculations on this. I'm yet to have them verified, and then we'll actually publish them on our website in a blog and in our newsletters. But the ultimate answer is yes, dividends are still tax efficient compared to being an employee or a sole trader, but the margin in which they save money is a lot smaller. And actually the point at which, if you're drawing every single penny out of your business, the point at which a sole trader would actually save more money happens earlier. It is in, if you're earning about £100,000 drawing out of your business, then you might be on the cusp of which one's better. But I would also say there's another aspect to that, is that if your business is generating more cash than you need to draw for lifestyle costs, then a limited company may still be useful, because if you are using some of that money for investments, you may not need to draw that money personally in order to make those investments. So it's understanding the profit level of the business and what you're using the drawings for. And I actually would bring that back to that break-even analysis. What's your lifestyle costs and what's your investment requirement? So if you want to invest a certain amount of money every year, then knowing the difference between how much you need to earn for lifestyle and knowing how much you need to earn for investments is really important for getting the right tax structure. So once again, the tax changes mean we don't have any golden bullets to fire. It's going to get a little bit more complicated, but there is definitely routes to make sure you're efficient. And ultimately, limited companies can still be quite lucrative. So yeah, I think we will end it there as we've gone over time. Hopefully we've been thought-provoking, provided some information for everyone. I just want to say thank you very much, Emma, for joining us today and bringing your expertise.
Thank you for having me.
That's an absolute pleasure. And I'd also like to thank my marketing team, Amanda, Aisha, behind the scenes, making sure all of this works and making sure Emma and I turned up on time and delivered appropriately for you. So thank you very much, everyone. Yeah, contact us if you've got any further questions. I'm sure Emma and I will be able to help with anything that hasn't got in the question and answer box. All right.
Gladly.
Thanks very much, everyone. Bye-bye.
Bye-bye.